Hey everyone, how's it going? My name is Richard Moglen, and welcome back to the TraderLion Tuesday tutorial. And today we'll be talking about the subject of downtrends. And downtrends are basically when the net sentiment is negative and the stock falls in price for an extended period of time. And this happens to every stock at some point or another. And it's very important to learn how to manage things and also identify downtrends. So whether you're a trader or investor, you know when to exit a position. So here's what we'll cover in today's video. First, how to define a downtrend, investing versus trading in managing downtrends, stage analysis, which is a really important and useful concept, how to stay realistic, and we'll go through a ton of examples of leaders versus laggers and finish things up with some key takeaways. So first of all, how do you define a downtrend? Basically, you want to use multi-timeframe analysis to identify the trend on whatever time frame is relevant for you, whether you're a trader and use daily charts or more of an investor and use weekly or monthly charts. And basically, you can use moving averages to objectively define that basically is a stock in an uptrend or downtrend over a certain period using that period moving average. So if you're looking at a weekly chart and the stock is above a rising 30-week moving average, this red line here is a 30-week, this stock is in an uptrend over this period. But as soon as we cross below that moving average, we've now entered a downtrend. And this is what we definitely want to avoid because you can give back a lot of the gains you made during this strong uptrend. You can also use anchor VWAPs and put them at relevant spots like this prior high here. If we're below that, then the net owner of stock is at a loss if we're below that anchor VWAP, but that's more of an advanced technique, and I'll probably make an entire video about that subject very shortly. But basically, the moving averages allow you to determine whether buyers or sellers are in control. If we're below a declining moving average, we're in a downtrend over that period. And if we're above that same moving average and in a sustained uptrend, then most likely buyers are in control. And weekly charts are great at determining kind of the true trend of a stock at any given moment. So I would highly recommend both traders and investors look more at weekly charts and determine whether they're trading with the bias of the longer term time frame. That's a great way to kind of align everything and basically have a higher probability of a trade becoming successful. So with that said, let's move on to investing versus trading. Basically, and this is kind of very general here, traders like to go base to base. We like to ride the trends, not so much sit through consolidations that last more than a week or so. And investors are trying to play that longer term move. So say this is a base right here, a trader might buy it here and try to ride and get out as the stock breaks this 10-week moving average, while an investor is trying to get in right here just as the trend really starts going and is trying to ride this longer term move. Now, all time frames can use charts. If you're more longer term, I would suggest the weekly chart, monthly chart, and basically the 10-week moving average should hold base to base, and the 30-week, this red line here, should hold the majority of the move. And here we've got an example of SQ. The entire move right here was pretty much held by the 30-week moving average. Then we entered a longer term basing period where we gave back a lot of these gains and then started a new uptrend as we basically started to trend once again above the 30-week, a rising 30-week right here until this point where we're potentially entering another consolidation period. So the 10-week is great for traders and investors for that shorter term trend, and the 30-week should be that overall longer term move and should keep you in that stock for most of it. So that's kind of the differences between investing versus trading, just really the period of moving average that you're using. And basically the concept we've been talking about is stage analysis from Stan Weinstein. And if you haven't yet read Secrets for Profiting in Bull and Bear Markets, I would highly suggest it. A very useful book for both investors and traders. And also go ahead and check out my interview with Stan that I did earlier this year. It should be popping up right now. But basically, we want to be involved when we're in a stage 2 uptrend above a rising 30-week moving average. And we want to be out of a stock when we enter a longer term stage 4 decline below a declining 30-week moving average. So traders like to buy continuations in stage 2 uptrends, and investors try to get in earlier, maybe in that first base here, and try to ride for the longer term move. So with that said, let's go through a bunch of examples and basically put this to use in real life. And here we've got a weekly chart of Nvidia. We've got a longer term consolidation here, and maybe we start the stage 2 uptrend right here as we get above the red line here, or maybe we wait all the way until here. But nevertheless, we start a really strong stage 2 uptrend. This is when we want to be involved and trying to find spots to enter with good risk reward setups. and traders will trade base to base as it rides at 10-week, and investors will try to ride basically that longer term move. And nevertheless, both traders and investors want to be out when we enter a stage 2 uptrend, and often this starts with a break of the 10-week, then a break on volume of the 30-week, that longer term period moving average. But just because the stock is in a stage 4 doesn't mean it's gone forever, but it might just enter a longer term consolidation period and then set back up again into a new stage 2 uptrend. And one more really important thing here is when we do enter the stage 4 decline, we start underperforming the S&P 500. This is the relative strength line. It's declining at this point right here. And we always want to be involved when stocks are overperforming, but obviously we want to be in cash or looking for new ideas once stocks start breaking down and just waiting for them to reset once again. Maybe when their fundamentals improve, then the price will kind of tell us that by the net sentiment of the largest funds and institutions piling money into these names, causing the price to increase. So with that said, let's move on to some more examples. Here is Roku, and it's been pretty choppy from its IPO. It's suffered a bunch of large declines, but if you're a trader and using that 10-week moving average, you've managed to capture some nice runs, but get out before it really suffers a 40, 50, 60% decline. And just now we had the most recent stage 2 uptrend. Once again, the 10-week was an excellent moving average to use as a trader. Then it breaks out right here, enters a late stage base, and now we've entered a stage 4 decline with price trending below a 10-week and declining 30-week moving average. And we're also starting to underperform right here. So basically never fall in love with a stock. If it enters a stage 4 downtrend, exit, wait for it to turn things around. These stage 4 downtrends can last a lot longer than any of us think. And you can see how it's severely underperforming the S&P 500. So there's many better opportunities out there to put your cash to use than this stock, even if you did make really nice money back in this uptrend. And many people just kind of let these round trip all the way to their entry points without realizing that the trend is now against them. So don't be one of those people. Keep an eye on those weekly charts and make sure you know what stage of the uptrend you are in. Next up, we've got Teledoc, another FinTwit favorite that's now in a stage 4 downtrend. And I'm sure people are trying to buy the dip here, 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 here. It just keeps on dipping. So when the stock is in a stage 4 downtrend, the net sentiment of the largest institutions is negative and they are exiting their positions, and that is why the stock is in a decline. And often we get rallies to the 50-day or the 10-week here or the 30-week moving average, the red line here, and then we see some additional shorts pile on. People use that rally to sell into. So everything is suspect when you're below a declining 10-week, and especially when you're in a stage 2 downtrend below a declining 30-week moving average. So focus on stocks when they're in a stage 2 uptrend. Right here, that is when the big money is made, and in stage 4 downtrends, that is when the big money is lost. Next up, we've got Zoom, another example from 2020. Great stage 2 uptrend right here. And then we formed a stage 3 here, which is kind of chopping around these moving averages. And now we've entered a stage 4 decline. So once again, people are trying to buy the dip here, here, here. It just keeps on dipping. So once again, wait until the trend of the stock is back in your favor and it restarts a stage 2 uptrend. And here we've got Peloton, another great example from 2020. Here we have a beautiful stage 2 uptrend, then transitions over to a stage 3, and then it leaks into a stage 4 decline. You had a big gap down on earnings here, and often the gap downs happen when the stock is already in a stage 4 decline, and the gap ups often start that stage 2 uptrend or happen on continuations from bases here. So never fall in love with a story. This is basically a round trip from 41 up to 150 or so and back down to 41. Never let a huge gain like that completely round trip on you. Moving on, we've got Alibaba, another example where many people on Twitter I saw were trying to buy the dip here, 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 here. Every single rally got sold into, and it really respected that 10-week moving average on the downside. And here we see it's fallen from about 275 or so all the way down to 124 at this moment. And even though it might rally a little bit, it's still very suspect, and you can see that because it's really been severely underperforming the S&P 500 for quite some time. So focus on stocks in stage 2 uptrends right here. That is when the big money is made, as I've said before. And once the stock enters a stage 4 decline, nobody knows how long this will last or how far down it will fall. So with that said, here are some key takeaways. Downtrends can last much longer than we think. Weekly charts reveal the true trend of the stock, what institutions are doing, whether they're accumulating or basically selling off their positions. and price trends are the truth, not the fundamentals. Basically, every single one of these stocks, people on Twitter have been saying their fundamentals are fantastic, but that's just not reflected in the price trends, which is the ultimate decider of whether a stock is good or not. So with that said, I hope you guys enjoyed this video. If you did, go ahead and leave a like down below and subscribe if you're new to the TraderLion channel. I'll see you guys in future videos. Thanks.